So big news from the Federal Reserve today. We're going to talk all about that. We're going to put it in simple terms and try to make it clear to everyone. And at the very end, Ashley has some very interesting information not yet heard from the Fed that we'll discuss as well. So today I'm here with Ashley Schnetzer. She is our controller here at Morgan Financial.
That's right.
And not only are you the controller, but you've also helped form and ran our secondary department, correct?
Correct, yes.
Okay. And for those of you out there who don't know what a secondary department is,
secondary department is basically the functions of after you close the loan, right? So delivering that loan into what they call the secondary market, selling that loan off to private investors as well as to the banks and the government servicing entities like Fannie and Freddie. So it's what happens with the loan after it closes. It's all the mortgage-backed security talk that people might talk about. It's that entire market that creates those financial instruments.
And let me break that down because that's those might be complicated terms. Mm-hmm. So really, it's the rates and the locks, right, and how we sell loans and how people buy loans. But the important part there is the financial piece of how that lock or how that rate is kind of formed, right?
That is true, yes. I mean, the expectation of where you would end up selling that loan for is essentially what helps drive interest rates.
Right. And so obviously, Ashley is very big, integral part of our financial piece. And that's why she's on here today to help talk about that Fed announcement today. So Ashley, what really was the announcement today? What about the rate hikes? And we'll start there with the rate hikes. What was the announcement today?
So the announcement today was no rate hike. So they have left the federal fund rate unchanged at 5.25 to 5.5, and at that range. So no news, good news on that front.
Right.
But there was also a lot of other really good announcements and things that kind of centered around that.
Yeah. So let's just start there. The rate hike. So a lot of people, that was kind of baked in, right? People expected there to be no rate hike today.
That's correct. Yes, the market was already expecting that. The market was already forecasting that. I think as high as like 98%. Probability that there was going to be no increase to rates today. And
so the impact, I mean, we've talked about rate increases. So the impact of a rate increase, it's really, its purpose is to destroy demand,
yes,
right, by raising rates so it costs more to borrow, right?
Exactly.
And it affects directly things like home equity lines of credit, credit cards, auto loans, but it has an indirect effect on mortgages.
Correct. It has mostly an indirect effect on most rates of those kinds because the Fed actually helps control the rates at which banks would borrow amongst each other. And therefore, then those rates end up being passed along to the consumer as well as larger firms and the like. So
okay, cool. So that's the base rates. The rate hasn't changed. It's at what, 5.25 to 5.5, depending on which rate you're talking about.
Yeah, exactly. Depending on what index you're using. Yeah.
Yep. And so, but people celebrate a no rate increase. Why is that? Right.
So, I mean, there was still a possibility, and of course, we've been dealing with, I think, what was like 11 rate hikes that we've been dealing with since they started this current tightening policy. So, the no rate hikes is also good news because of the potential for relatively unchanged, as well as the potential for rate cuts in the near future.
So the federal funds, or the Fed,
yeah,
their target is 2% inflation.
Correct, yes.
Yeah. And so they know that in order to hit that, you can't just get to 2% and stop. You don't want to overshoot that mark.
Yeah.
So they're going to stop well before that, correct?
Yeah, and that's what it's looking like. That's what most of their forecasts are coming in at, is that they expect more of the long-run inflation, probably going out a couple of years, actually, to finally get to the 2% target.
Okay.
Yeah.
So I guess the exciting news today was the more anticipated news today was in the dot plot. Can you explain what the dot plot is?
That's true, yes. The dot plot is very heavily scrutinized, as well as every single word that the Powell uses.
Yeah.
But the dot plot is basically the Fed is made up of a board of governors, right? And they meet and they provide their expectations, and then that helps derive where they set their federal fund rate target at. But they also come up with where they expect things to be in the future, right? So it is a survey from those participants, those people that actually participated in the meeting, about where they expect certain things to go, including the federal funds rate, of course, as well as things like the unemployment rate, and GDP is in there. So just a lot of expectations they have there. But the dot plot in particular is basically it's just a bunch of dots on a on a graph where they expect rates to be at for the next couple of years.
So it's those individual people on the FOMC.
Right.
It's on that committee. It's their prediction of where the federal funds rate is going to be next year.
Correct. Yes.
And so they call it a plot because there's like you said, bunch of dots on a graph.
Yeah.
So where do these dots land this time?
So the dots landed that they are expecting rate cuts next year still. So they were expecting that prior, and now they're expecting that the rate cuts might actually be a little bit lower than the last expectation, the last time they released the dot plot. Rather than the federal fund rate coming in closer to 5.1 next year on average, now the median, excuse me, not the average, the median is closer to about a 4.6 right now. So that's actually like a 75 basis point drop from where we're at right now.
So to the layman out there,
yeah,
and we don't expect all of our followers to understand what we're talking about right now. Can't. This is too much.
There's so much stuff around it. Yeah.
Let's put this in very easy to understand terms. What is the Fed predicting for next year?
So right now the Fed is predicting, according to their survey and according to those dot plot, that at least it looks like it's going to possibly be 3 rate cuts next year.
Okay.
And then the median rate would end up somewhere around 4.6.
All right. And I'll take that even a more simplified route, is that the Fed is predicting rates will come down.
Correct.
So those are the federal funds rate, right?
Yeah.
Now we say mortgages are not directly impacted by the federal funds rate. They are two different things. The Fed does not set mortgage rates. Let's repeat that. The Fed doesn't set mortgage rates.
They do not set mortgage rates.
And so the rates that they set, is an indicator that they think the rates are going down because inflation is going to go down.
Because they're expecting that some of the, whether it's the inflation data, the jobs data, all of those things are going to come in and they're going to still be able to actually kind of ease up on some of their tightening. Okay,
so they tighten in order to slow the growth down. It's too hot.
The demand you're talking about.
The demand.
Yeah.
And so now they think, well, that growth's going to slow down. So if inflation is going to slow down, growth's going to slow down, what happens to mortgage rates?
Well, mortgage rates will actually start to come down as a result of the expectation as well as the rates actually coming down.
Right.
So.
And that's the excitement today.
Yeah.
That, and now I look at the mortgage-backed security market, which really is a much better indicator of mortgage rates out there.
Absolutely, because that's where a lot of that gets derived from. Because of course, I'm going to lock you at a rate that I think I can make money at.
Correct.
Basically.
Right, and that's how rates are determined. It's the mortgage-backed securities. What I can sell that security for will dictate the price on the street.
Correct.
And so obviously the mortgage-backed security or the mortgage market rates are reacting in kind, and we should see a little bit of a pullback in mortgage rates.
Yeah, exactly. Especially because your mortgage rates are not largely let me back up and say, they're largely driven by the expectations of where things will be in the near future. Mm-hmm. So it's not just where the rate is now, it is where they expect the rate to go.
Right. So the other thing about mortgage rates that a lot of people don't understand is that they change on a daily, sometimes hourly basis.
Yes. Yeah. I mean, just looking at the Fed's announcement from prior and then after the announcement, you can just see the market just changing as a result.
I know the loan officers talk to clients and say, the clients are like, well, let me think about that rate tonight. And loan officers will say, it might not be there tomorrow. And the clients are thinking, oh, this guy's just trying to hustle me or push me into this loan.
Yeah.
When in reality, they're telling them the truth that those rates can change. So like the rate today is going to be different than the rate yesterday.
Absolutely. I mean, I can sometimes see rates change as soon as like every 15 to 30 minutes.
Right.
So.
And if the market's falling through the floor, they'll stop.
They will, yeah.
Most people, Fannie and Freddie included, right, will stop rate locks.
Yeah, they'll actually suspend pricing.
Right. Mm-hmm. Okay, so let's go back a step. So today, this was significant because no rate hike, right? So that signals that the demand destruction that they're doing is working to some degree, and that the economy is not in overheating and it's actually not retracting, but the growth has slowed.
Yes.
And I saw we had numbers come in this morning on the core producer price index, core PPI, which is not the consumer price. It's not the price of consumers. It's the price of the producers, right? Yeah. And it came in better than expected. So the first thing we're going to see is the pricing for producers come in better than expected, and then later it translates into pricing on the street, right?
Absolutely.
So that's an indicator of what they're doing is working. Now they also mentioned one other thing. I didn't address this with you earlier.
Yeah.
But they talked about their balance sheet. Okay.
They did, yes.
And so the Fed, quantitative easing was when they, in 2010, 11, 12, 13, 14, all the way up to through COVID, right?
Right.
They were buying mortgage-backed securities, and they were buying T-bills, or what was the other thing? It was some other bond.
Yeah, they were buying bonds. I mean, and essentially when you buy it, they're buying the asset and they're giving out cash. And so they're stimulating the economy by actually increasing the supply of available funds. And
they're also, some would call it artificially bettering the price of those rates, right?
That is true, because at the end of the day, if you wanted to sell something, you knew that there was a buyer there.
Right.
Yeah.
And so some would say that since they've been selling it, they've been doing quantitative tightening, that they've been artificially making that market worse than expected, right?
Including of mortgage-backed securities. So they made a big mention about not only tightening up on the supply of not only tightening with their own T-notes, but actually on mortgage-backed securities that they hold as well.
Right. So did they make mention of that today? Did you see that in the article?
Yeah, they made mention that they were going to continue the pace at which they've been doing, and they were going to continue that tightening.
Okay. So that might, so don't expect rates to decrease overnight. It's just not going to happen. It's going to be a long-term thing, right?
A long-term thing. And I mean, I would tack onto that and add that not only don't expect them to decrease back to the levels of when they were doing such massive quantitative easing. Excuse me.
So we shouldn't expect 2% rates tomorrow, right?
No, I don't think so.
Okay. I wouldn't even want that, quite frankly. It wasn't good for anything. But that's not entirely true, but it's great for people to have affordable rates, but it's also causing a lot of the inflationary problems that we're having today.
Exactly, yes.
So the rates are going to be trending downward. Is that a fair statement? Trending with a lot of volatility in between. Yes.
It won't go like this. It'll go like that overall.
Right. And for those of you who are listening on podcasts and aren't watching the video, what she's doing is saying it's going to be up and down, but the trend might be downwards. And this is coming from a different perspective. But remember, if you're out there on the sideline saying, I'm waiting for the rates to go down,
yes, that
you are not alone. You are not alone. And rates are starting to go down. People are going to rush back into the market.
Exactly.
In my opinion, this isn't financial advice. I'm not a financial advisor. I'm just purely telling you my opinion. But my opinion is that people are going to rush back into the market. The flexibility of a seller right now is more flexible now than it will be when people rush into the market.
Yeah.
So I believe that there's a lot of pent-up demand from the last year and a half, 2 years of rates being high, that there's a lot of people that are saying, I'm going to wait till the rates go down. They're going to rush into the market. It's going to be a seller's market again, and prices are going to rise more rapidly.
Yes. I mean, to how much, to the extent of what you're saying, I mean, we don't really know, but
we don't know.
It would make sense. I mean, the whole point of them increasing the interest rates is to actually kind of stymie demand, right?
They wanted people to stop buying houses.
Right. So if you're going to pull back on demand and you can't really fix the supply issue, because they don't have
supply
control
is still
of
low.
Supply is still low. Demand, they were trying to make kind of match in line with supply in order to make the inflation numbers actually come down. But as soon as they start raising interest rates, the point would be, decreasing interest rates. I'm so used to saying increasing interest rates.
Sure.
But decreasing interest rates, then the result would be that some of that demand is coming back, and therefore the supply is still not going to equal the demand.
Right, and so that lack of equilibrium between supply and demand means prices are going to rise. And so a lot of things we've been talking to clients about is, look, if you were thinking about buying the house in the last 6 to 12 months but didn't, because of any of these factors, you're worried about the market crashing, you're about rates, you wanted to wait for the lower rates, you're going to end up paying more, because I believe home values are going to continue to go up. I mean, we just saw the Fannie Mae and Freddie Mac increase their conforming loan limits by 5% because that's what they think that markets are going to go up by.
Exactly.
And on a $500,000 house, that's $25,000, right?
Even if it came in at the same inflation numbers that we're expecting, right?
Right.
Because the point out is that the Fed is not targeting a 0% inflation. They themselves are still targeting 2% inflation.
Correct.
Which means even on the low end, prices are still likely to rise.
Yep.
And
so, my advice to people out there that are on the fence is to get off the fence, because you're going to end up paying more. Now, we took a very tactical thing, and I can't help to come back to that to the client. It's like prices are going to rise. Rates are going to come down eventually. We don't know when. We kind of know how, right? It might be slow, it might be fast. These are their targets. Now, that doesn't mean I'm sorry, these are their predictions.
That is true.
Not their targets.
Yes.
Right? This is their prediction. This is what they're predicting. This is their guess. And the guesses range from unchanged, 5.5 to 5.25 to 2.5. I've seen the predictions.
Yeah,
all
the
around.
dot plot there.
The dot plot is
going all the way
between
down.
2.5, and this is on the federal funds rate. This is not a mortgage rate. It's
Correct.
not. They're not guessing 2.5% mortgage rates, but 2.5% federal funds rate might translate into a 5.5% mortgage rate. All things being considered an equal.
Yeah, all things considered equal,
Right.
with the understanding that they don't expect something else drastically different in the near future.
Right.
Yeah.
But if rates drop that fast, there would be a slew of people that came in, and
Yeah.
it would make that it would make it like 2020 and 2021 all over again with the amount of home buyers out there.
Yeah, there would definitely increase the demand pretty quickly and much more quickly than the supply would increase.
Right. Okay. Well, I look, this is a lot of good info. I think if you were to wrap it up or sum it up, what would you say?
I would say that, so overall, the announcement from the Fed today was that rates are going to be unchanged. They actually did make a mention, a little bit of a language change, that they don't actually expect any future rate increases as of right now. They are expecting.
That's new.
That was new,
Right.
is that they kind of left it a little bit open door, and today they closed that door just a little bit more.
Okay.
So they are expecting the next step would actually be interest rate cuts, and that's expected sometime next year.
Okay.
Now, whether or not that actually means that suddenly this house goes down in price drastically, I probably not. So if you're out there, if you're considering buying a home, if you can afford it now, it's better off to consider taking that action now.
Right. Well, good. Well, you heard it here first, probably. And so if you have any questions, comments, concerns, please put them down below, left or right, or however you're consuming this information. Send us an email, text, carrier pigeon, whatever. Just get us the information. Maybe not a pigeon. But bring the questions to us. We'd love to hear from you. Let me know your thoughts and comments down below. If you're not a subscriber, please subscribe. I should have said that in the beginning.
Yes.
And if you made it this far, just do me one favor. If you made it this far, go ahead and hit the like button. That's all I got. Thank you very much, Ashley, for coming in today, and we'll see you next time.
Thanks, Joe.